All right, thank you so much for joining us today. I think everybody's here now, so we can go ahead and get started. Tracy, are you good to go?
Yeah, absolutely.
Okay, perfect. So thank you so much for joining us, everyone, today. My name is Katie Manikis, and I'm working with the Brain Injury Association of North Bay and Area on Biamba Aware. This is an education and prevention of financial abuse program. So over the course of the next year, we're going to have various presentations about financial education, financial empowerment, how to avoid scams and frauds. So today's presentation is on, let me just keep going here. Working with a financial advisor. Today we have Nick and Tracy joining us, who are two licensed financial advisors, and they're going to take us through the information, and we're going to learn lots of new information and how to educate ourselves and stay safe. So thank you so much, Tracy and Nick, for joining us today. A couple things. I'm just going to let everybody know that your camera and mic have been turned off, as I am recording this presentation, and we will have it available on our Biamba YouTube channel afterwards. So feel free to unmute yourself if you have a question throughout the presentation. I just like to keep the sound off to avoid all the background noise. So without further ado, I'll let Tracy and Nick take it away.
Perfect. Thanks, Katie. So throughout the years, financial advisors have had a reputation for being self-concerned, expensive, and dishonest. A lot of people think that advisors are out there just to make a quick buck and then ignore the client. As with any industry, there are some who fit the description, but most of us actually care about our clients and their financial well-being. So today we're going to explain a little bit about how you can be confident with your financial advisor, that they're qualified to help you, a little bit about the fees associated with investing your money with a financial advisor, and explain what you should expect from your relationship with your financial advisor and what they'll expect from you. So licensing and qualifications. One thing you should always check when working with a financial advisor is that they are licensed and qualified to work with you. So firms or individuals must be registered to sell investments sell investments or offer investment advice. In Ontario, financial advisors must be registered with the Ontario Securities Commission. And depending on the type of advisor as well, there will be different licensing as well. So mutual funds advisors use the MFDA, and securities advisors use the IROC, which is IIROC. Some financial advisors also offer life, critical illness, and disability insurance. Lots of advisors will call this risk management or lifestyle protection plans. In Ontario, financial advisors must be registered with the Financial Services Commission of Ontario or the Financial Services Regulatory Authority of Ontario. So it was previously the FSCO, which is the Financial Services Commission of Ontario, and it's changing into the FSRA. To find out if a firm or individual is licensed to provide the investments and advice, you can go to the website listed here, osc.gov.on.ca. Under investors, go to check before you invest and then click on check now. This will bring you to the Canadian Securities Administrators website, where you can search for an individual or firm. When you do that, it should list the name of the advisor, where they advise, and a little bit about their qualifications as well. We do have to keep the government up to date on all of our designations and qualifications and any outside business activities as well. To find an individual who is licensed to provide insurance, you do a similar thing. You just go to fsco.gov.on.ca. That link is still active, and it shall remain active for quite some time as they're switching over to the FSRA. Under our services and regulated sectors, click on insurance, click on licensed representatives listings. On the left-hand side, then click on agents, and you should get the same information, a little bit about the advisor, who they are, where they advise.
Okay, so when you're working with a financial advisor, odds are good they're giving you a business card, and on their business card, they may have several different designations. So this is just to explain briefly what the most common ones mean. So a certified financial planner, or a CFP, means that the person has met the experience requirements, which is 3 years minimum practicing in the financial services industry. And they have also met educational requirements as outlined by the Financial Planning Standards Council. And they are also obligated to meet continuing education requirements. So where Nick and I work, there's always training and courses that are being offered to us that will provide us with that continuing education requirement. We can also go outside and look for other courses and whatnot that will meet those requirements.
Just to
And
piggyback off that real quick, sorry.
yeah, for sure.
The CFP is currently one of the top designations in Canada. So if you're working with an advisor that has their CFP, you can be rest assured that you're working with somebody with experience and who is very qualified.
Yes, absolutely. An RRC is a registered retirement consultant. So people who use this certification have met, again, an experience requirement, 1 year minimum working in the financial services industry, and educational requirements that are outlined by the Canadian Institute of Financial Planning. And they also have continuing education requirements. And then we have the QAFP, which is the Qualified Associate Financial Planner. People who use this designation have met the experience requirement, which is 1 year minimum working in the financial services industry. And the educational requirements is outlined by the Financial Planning Standards Council, as well as continuing education requirements. So a QAFP is a designation that you can achieve while you're on your way to getting your CFP, or Certified Financial Planner. So if you're working with somebody who has a QAFP designation, odds are good they're looking at doing the entire program and achieving the Certified Financial Planner designation.
Your first meeting with a financial advisor. So a couple things to look for. You should never be asked to pay for a meeting with a financial advisor. That's not the way we're compensated. The majority of our meetings are absolutely free. If somebody is asking you for payment for a meeting, you should ask exactly why there is payment and be very, very skeptical of that. So most of us are compensated through the investments they manage for the clients, and also for the other investment products and insurance products that we utilize in our strategic planning. So if you choose to invest the money with them, that is when the fees will be coming out, and that is when we get compensated. These fees should be paid off of the investments or through the investments, meaning you should never receive a bill for payment. So when you go into your first meeting with a financial advisor, you should have an agenda with you. You should know what you want to discuss, what your financial objectives are, and what your goals and concerns are. A lot of people will walk in and not really have much of an idea of where they want to go with it. They just know they need help. It's important to go in with goals so that you're not steered in a direction you don't want to go. Another good idea is to bring someone you trust with you. You can expect a lot of information to be shared at a first meeting, so having another person listening and perhaps taking notes for you may be very helpful. Now, your advisor will be taking notes as well, but the advisor will take notes that are more pertinent to their business than to your financial situation. If you have an acquired brain injury or other cognitive impairment, you may want to inform the financial advisor of this before your meeting. This will give them the opportunity to tailor to their agenda to make it easier to understand. Now, there wasn't much regulation regarding this recently. However, a lot of the firms are emphasizing the need to tailor meetings to the individual client's needs. I know Tracy and I were just on a meeting 2 days ago where they mentioned that it is important to tailor the flow and the content of the meeting to the individual clients.
Nick, I just add one thing. If you are going into a meeting and you're going to bring somebody with you that you trust, keep in mind when you have a meeting with the financial advisor, you're going to be disclosing all of your financial information. So anyone who's in that room is going to be hearing what you say. And so you want to make sure anyone you bring with you, you're comfortable with them knowing all of your intimate financial details.
Absolutely. We basically ask you to financially undress. We want to know every dirty little detail because we need to know everything in your financial situation to accurately prepare and plan for you. So most of the questions you ask a financial advisor will be based on your particular financial situation. Here are some other considerations. Ask about the financial advisor's work and education experience and ask for an explanation of any designations they have. Ask why they became an advisor. Ask if printed materials related to your meeting are available to help summarize the discussion and explain terminology and concepts. This is something that I've been trying to improve on. I tend to use a lot of abbreviations and a lot of terminology that isn't plain language, and then I have to circle back and explain that. So don't be shy. Ask your advisor to explain things and ask for printed materials if you need to. Ask if the financial advisor's firm offers online access so you can view your investments anytime you wish. That's an important one as well. A lot of firms have been doing mail-in statements, stuff like that. Online access just increases the transparency, allows you to look at your investments and investment products anytime you want. Also, ask how often the financial advisor will check in with you or how often they plan to meet with you. That is a very big personal preference for a lot of advisors. Some advisors meet once a year, some meet 4 times a year. It's just important to know how often you will be in contact.
Okay, so one of the big, I guess, mysteries of financial advising is the cost. And people tend to think that if you deal with a financial advisor who's with a firm, it's going to cost you more than if you walk into a bank and request to set up say an RRSP. The truth of the matter is, whether you do this with a bank or whether you do this with a financial advisor who's with a firm, you're going to be paying fees for your investments. So mutual funds all have fees associated with them, and the fees that you pay are taken directly out of your investments. So you should never get a bill from somebody saying, okay, for this quarter, you owe us this amount of money for servicing your account. Next slide, please, Katie. Thank you. So there could be some slightly different language used depending on who you're talking to and what firm they're with, or if they're with a bank. But these are the most common fees that you will see. So an MER is a management expense ratio. So with an MER, the bulk of that goes to whoever's managing the fund. And then a smaller portion of it is an advisory fee that would go to the firm and or the consultant or financial advisor that you're dealing with. And the MER, or management expense ratio, varies depending on the fund, and it's always expressed as an annual percentage of your account balance. So MERs can go anywhere between, it could be as low as maybe 0.5%, and I've seen some MERs over 3%. It all depends on the mutual fund that you're invested in. And just one other note on the fees that you pay: when you see the rate of return for your investment, that rate of return should be after these fees have been taken out. So your rate of return that you see should be the true rate of return of your investment. The advisory fee, some investment firms will charge a lower management expense ratio, or MER, and then they will split out the advisory fee. So, or the dealer service cost is another way to say that. So by charging a separate advisory fee, there's an added element of transparency there. So you know exactly how much you're paying for your financial advisor's time and expertise.
Quick note on that, the MER is on every mutual fund, no matter where you buy it through or who you buy it through. The advisory fee is an optional charge that some companies do just to add transparency.
So depending on the fund that you choose to invest in, there could be additional fees associated with that particular fund. So these are some of the terms that you might see. Some funds are front end load. So basically you're charged a fee when you make the initial purchase. Some are back end load. So you're charged a fee when you redeem or sell your investment. Some funds are no load, which I think it's safe to say Nick and I probably prefer those. And there's no load fee charged at all. And it's important to keep in mind that these load fees are different than the MERs. So in all of these cases, you're still paying that management expense ratio, but you may or may not have a load fee on top of that, depending on the investment. A deferred sales charge, these are becoming less common, I believe. Some mutual funds will charge a sales fee that could decline over a period of 5 to 7 years. So if you buy into a mutual fund that has a deferred sales charge, and 3 years into it, you decide to pull money out, you could be charged a fee for pulling your money out, and it could be on a declining scale. And the final one is a trading expense ratio. This is usually a very small percentage. And by that, I mean, it could be like 0.05% kind of thing, expressed as an annual percentage of your investments. Sorry. These are fees that are related to the fund manager buying and selling the securities within a mutual fund.
Creditor protection insurance and mortgage insurance. So if you have a credit card, loan, or mortgage, you have likely been offered some form of creditor protection insurance. While this is always sounds like a good idea and a useful and affordable insurance, it is important to understand the following about it. Any insurance you should buy should be based on a needs analysis performed by a licensed insurance agent. So they'll walk you through a set of criteria, and then it will spit out a number for the maximum amount of insurance that you can possibly buy. That doesn't mean that's the amount you should buy. That just means it's the maximum amount that you should be able to buy. In the event that you make a claim, the lender gets the money, not you or your family. Now, this is specific to creditor protection insurance. So that means the credit card company or the mortgage agent or the loan officer would get the money to pay back the owed money. Quite often, the underwriting of creditor protection insurance occurs when you make a claim and the policy may not pay out. This is different than most other forms of insurance where the underwriting happens before you can make a claim. So the underwriting happens upfront before you get approval, and then you have the policy. With creditor protection insurance, it's the opposite. It happens at the end, which means you may not be eligible to make that claim after all. Sometimes creditor protection insurance provides a benefit if you lose your job. For example, it claims that it will maintain minimum payments on your credit card if you end up out of work. This provision may not apply to self-employed individuals, and there may be a time limit on the minimum payments, for example, 3 months. It's very important to read all the fine print and possibly have somebody you trust read it over with you, just to make sure that you have all the details and you're not missing anything. This type of insurance is often more expensive than purchasing a term life insurance policy where the underwriting occurs before you are approved for coverage. Also, if you purchase your own life insurance policy, you determine who receives the money if there is a claim by designating a beneficiary. The other thing to note is that if you are getting your own term life insurance, you can set the amount, whereas with the creditor protection insurance, it will only be for the amount of credit you are taking on. If you are paying for creditor protection insurance and aren't sure that it's the right coverage for you, contact a licensed insurance agent and request a quote for term life insurance policy. A licensed insurance agent will perform a thorough insurance needs analysis with your input to determine appropriate coverage. So any life insurance agent out there should have a needs analysis tool with them at all times, and they will go through, show you exactly how much you can qualify for and how much you should qualify for.
Okay, so just a final or a few thoughts with regards to things that you really should be aware of when you're dealing with a financial advisor. You have a responsibility to have a basic understanding of what the financial advisor is recommending. So here are some indications that a financial advisor might not be working in your best interest. If it sounds too good to be true, it probably is. So, if you have a financial advisor telling you that you should be buying this particular fund because you're going to see, say, a 7% rate of return in the first year, unless that investment is a guaranteed investment certificate or a GIC, they can't guarantee you a rate of return. Even high interest savings accounts, which typically have had a quote unquote guaranteed rate of return. What we saw with the year that we had in 2020, when the markets took a tumble last March, we saw our own high interest savings rate, which was guaranteed, we saw it change, we saw it drop, and it dropped significantly. It's still guaranteed, quote unquote, but so unless you're into a guaranteed investment certificate, which is guaranteed for a specific period of time and a specific rate of return, there are no guarantees when you invest money. A financial advisor should never accept or request cash. There are various ways you can get money to a financial advisor to have it invested. Checks usually work, although that's become difficult in the COVID environment. The firm that we work for, we can be set up, actually, we being the firm, can be set up as a payee through your online banking, and money can be sent to us in that way. And it filters through our head office, and then we receive a notification that the money has come in. Most firms as well, and the banks, I believe too, have the ability to actually go into your bank account and take money directly out, but that should only be done with your permission. And a financial advisor should be willing to work with you through all the different stages of your life if that's what you're looking for. So Nick and I, we have the same sort of approach, I think. And, if I have a client who's 26 years old, has just finished school and is starting out, first thing we're going to do is determine his or her goals and concerns, which are going to be different than somebody who's in their 50s and looking at retiring in 10 years. So, you know, we like to do sort of a holistic financial plan. And we do this with the understanding that a plan is going to change as you go through life. Life happens. So before you sit down with a financial advisor, you really should think about what level of service you want, what you're expecting, and make sure that your financial advisor is going to provide you with that level of service that you're looking for.
A word about RDSPs. So an RDSP is a registered disability savings plan. This type of investment is intended to provide for long-term financial security of a person with a severe and prolonged physical or mental disability. This person is known as the beneficiary. So the beneficiary and the holder may be different people, but the beneficiary is the person who should be receiving and owner of the account, essentially. A beneficiary can only have one RDSP in Canada at a time. An RDSP can only have one beneficiary, and the beneficiary cannot be changed. The beneficiary must be a Canadian resident at the time the contribution is made, and that counts for all contributions. The beneficiary must be eligible for the federal disability tax credit, and the beneficiary must have a valid social insurance number. The beneficiary must be eligible for the federal disability tax credit. That's important because the government is actually going to contribute a certain amount into the account with you. So this just makes it so they can tax that accordingly. The beneficiary must be turning no more than 59 years old at the end of the year the contribution is made. RDSPs can receive grants and bonds, but only up to the end of the year in which the beneficiary turns 49. Lifetime RDSP contributions cannot exceed $200,000. If you're interested in RDSP, you should ask a financial advisor if they offer this type of investment. And it's a good thing to note that just because you have a disability doesn't mean the RDSP is the right solution for you. You should always ask the financial advisor about other types of investment products as well.
So in summary, as Nick was saying at the beginning of the presentation, even though we have a bit of a bad reputation, most financial advisors are honest. We work hard and we truly care about our clients, and we want to help them. That's, you know, one of the questions we suggest you ask your financial advisor or somebody that you're sitting down with to potentially work with is why they are a financial advisor. And, you know, if the answer to that question is, well, you know, I can make really good money, then they may not be working with your best interest at heart. However, if they say they love the work, they want to help people, they find it rewarding, I think you'll find that type of person is likely more, you'll probably get more out of that type of advisor. So you need to find somebody that you're comfortable talking to and someone that you trust. They're going to get right into the financial aspect of your life. And, you know, in some cases, financial advisors are with their clients for 20 or 30 years, depending on how old they both are when the relationship starts. So think of your relationship with your financial advisor as a partnership. The advisor provides advice and guidance, but it's your money and these are your decisions. It's the financial advisor is kind of like somebody sitting on your shoulder and helping guide you through situations that you may not be totally informed about. And we have knowledge and training and experience that we can pass on to our clients and help them make the best decisions. But you also have obligations to your financial advisor. So you have to tell your financial advisor if you experience significant changes in your life. You know, do you lose a job? Do you get a job? Do you get a huge raise? Do you inherit money? If you move, you know, they need to know how to get a hold of you. If your phone number changes or your email address changes, you need to keep them informed as well. So if a financial advisor presents you with the plan and you say, yeah, that's great, let's go ahead with it, and then you experience a change in circumstances and don't tell your advisor, it's entirely possible that that plan is not going to work. In fact, it's probably going to fail. So out of fairness to your financial advisor, you owe it to them to keep them informed. So a financial advisor should never judge you or put pressure on you to make decisions. If you are someone with an acquired brain injury or a cognitive impairment, making decisions might be a very difficult process for you, and you might need a lot of time to think about things, to understand things, and to come to a decision that you're comfortable with. A financial advisor should give you that space that you need to do it. They should never say, oh, just trust me and sign this and we'll get on with it. You reserve the right to change financial advisors if you're working with somebody that you don't think is working in your best interest, or that you're just not comfortable dealing with for some reason. Or, you know, maybe they don't, sorry about that. Maybe they don't communicate in a way that you can learn and you can understand. So it's always your choice who you're dealing with. It's your money and you make the decisions. And with that, we can open it up to questions.
So if anybody has any questions, feel free to add them into the chat box or unmute yourself. I'm just going to monitor the chat box here. I should also let everyone know that this presentation is also going to be available on our Biamba YouTube channel. And we do have some printable materials to go along with it. Tracy and Nick, I think it's okay if I share the PowerPoint as well.
Absolutely.
So I will be sharing that on the Biamba website, which I will type into the chat box here. Oh, is there a question? Feel free to unmute yourself if you'd like to ask a question. Oh,
I guess we did a good job, Nick.
Covered everything.
We have a comment here. It says very good presentation, very informative, especially the websites for checking credentials.
Yeah, that's very important. You need to know that the person that you're going to be, as Nick says, undressing with financially, you need to know that they're qualified to be taking that information from you and providing you advice based on it.
Something I just wanted to point out about the RDSP is I've seen some advertisements for companies that guarantee getting people qualified for the RDSP. And you have to go through an actual medical review application with your doctor to qualify for that. So I don't believe that any company can guarantee you will qualify for that RDSP.
Yeah, the RDSP, I have to admit, I personally don't know an awful lot about them. I've never set one up for a client, but I'm sure it's a registered product, which is the Registered Disability Savings Plan. So I know there's more than likely information on the Revenue Canada website or CRA website. In fact, as we're chatting, I could probably dig up a link and put it in the chat.
You have to apply through the disability tax credit paperwork, which has to be completed by a doctor.
Absolutely. If you don't
Yeah.
qualify for tax, you won't be able to qualify for the RDSP.
Yeah.
Another quick thing to note for anyone still on here, when you check your advisor on the websites that we've mentioned, the qualifications, it's a good idea to check the firm they're with as well, just to make sure that you have information on all parties involved. I personally check out any company that I do business with before I get involved with them, just to make sure that everything's above board. You can go online and see any fines or compliance issues they've had in the past, I believe for up to 20 years.
Oh, wow. That's good to know.
Yeah.
Perfect. So I don't have any questions in the chat. I'll give everyone one more minute if you want to unmute yourself and ask a question, or feel free to type it in the chat. Tracy's just put in the website for Canada Revenue Agency for the disability tax credit. So that is in the chat window if anybody wants to cut and paste that.
That's actually, Katie, that link is for Registered Disability Savings Plan.
Oh, okay, sorry. Yes, RDSP.
Yep.
Oh, I lost the chat box here. Okay, so I'm not seeing any further questions at the moment. If you have any oh, maybe I lied. Oh, so the question is, I joined late. Where can I check for a list of websites for credentials?
Okay, so that was one of the first slides. So there are, in Ontario, we should be very clear, we are in Ontario, and every province has its own licensing bodies. So in Ontario, Katie has just moved the presentation to the slide where we provide the websites. So you can check for people who are licensed to provide financial advice, and that is with the Ontario Securities Administrators. And then separately, you can check on people who are licensed to provide insurance, and that is with the Financial Services Commission of Ontario. So I think Katie said she was going to provide, she's going to put a copy of the presentation on the website. Is it, Katie?
Yep.
Okay.
Yeah, I'm going to put a copy on the website, and if anybody's interested in having me email the presentation to them, you can email me at byambaware@gmail.com. It's the email address here that's on the screen. I would be very happy to email out the presentation, but we will have it available in printable form on the Byamba website, and it's under the financial abuse section. Thank you so much, Tracy and Nick, for sharing this information with us today. It's very informative in making decisions about working with a financial advisor and investment. So we really appreciate you coming today.
Well, thank you for inviting us. It's always good. Any chance we have to educate people, I think it's a good opportunity for us as well.
Absolutely.
And if you have any questions after the presentation, feel free to email me again at byambaware@gmail.com, and I can pass along the questions to Tracy and Nick and try and get you an answer.
Yep, for sure.
Perfect. So for all of you, for our next presentation, it will be on February 4th at 11 a.m. And this is going to be on romance scams specifically, and it's going to be presented by the Canadian Anti-Fraud Center. So if you'd like to register for that, you can email me at byambaaware@gmail.com. And again, throughout the year, we're going to have lots of resources and information available to provide financial awareness and information to protect yourself. So once again, thank you so much, Tracy and Nick, for providing this valuable information. And we will be sure to highlight it and share with everyone because these are really important resources.
Thanks,
for having us.
Katie. Yep, thanks. And thanks for this program. I think it's important information, all the subjects that you're covering. It's awesome.
Yeah. Well, thank you so much, everyone, for joining us today, and we appreciate it. And I'm sure we'll see some of you soon.
Thank you. Have a good day, everyone.
Have a good day.
Thank you.
Oh.
Thank you.
Thank you. Thanks for joining us today.
Thanks, Tim.
Take care.
You too. We'll talk soon.
Bye.
Okay.